A seller came to me convinced that his business was worth $5 million because Anthropic had just raised $1 billion with zero revenue. He'd been sitting on the market for about 11 months and he couldn't figure out why the buyers weren't biting. I bought and sold 12 businesses of my own with my own personal money and deals on the line. I've represented over 200 private companies with an aggregate value of $400 million in sold businesses. The gap between what a seller thinks his business is worth and what a buyer is actually willing to pay, that's the giant difference between, say, $500,000 and $2 million. So instead of giving you the same valuation methods that every business broker will regurgitate, I'm gonna walk you through 7 myths about business valuations that cost the owners money when it comes time to sell. Stick with me to the end and you'll understand exactly why sophisticated buyers in the range of, say, $1 million to $12 million market actually pay for. And I promise it has nothing to do with what you read about unicorns on LinkedIn. All right, point number 1, you can't use Facebook's valuation as a comp for your business. You see, sellers, they see tech companies go out and raise billions of dollars with zero profit, and they figure that their mainstream business deserves the same type of treatment. This single assumption kills more deals before they ever get started than anything else that I see. I get sellers all the time that will pull up a LinkedIn post and say, hey, look, this company just raised $1 billion and they're not even in the profit yet. So why isn't my tech platform worth, say, 10 million or 50 million or $100 million? Or they'll point out that Anthropic has a pre-market valuation of $3 billion with no revenue. And they ask, hey, look, why can't I get the same multiple? Those businesses have nothing to do with the business that you're trying to currently sell. Venture capital is a hyper growth potential in a massive market. What VCs are really doing is they're buying lottery tickets. They're expecting 9 out of 10 companies that they invest in to fail. And they're looking for that one rocket ship that makes up all the losses and exponentially grows their investment at a profitable level. They literally will fund 95 companies knowing they will literally fund 100 companies knowing that 95 will fail. Because the 5 that hit, and when they hit, the return will be so massive, it'll cover all of the other losses that the 95 incurred. That is not how the $1 million and $12 million market, it works. It doesn't work like that at all. Buyers in our market, they are buying proven cash flow generating systems. They're putting up personal capital or they're borrowing debt from, say, a bank or an outside lender, private lender, and that needs to be able to generate a return within at least 5 years. They're not betting on the what if. They are buying what already works. A plumbing company that's doing 1.2 million in owner earnings is worth 3 to 4 times the multiple because the buyer can model the cash return. A tech platform with $200,000 in profits and the potential for scale gets heavily discounted because the buyer is taking on all of the risk of marketing the future potential. The problem really exists when you anchor your price based on the media valuation. You honestly just price yourself right out of the actual buyer pool when you do this. Qualified buyers with actual funding in place, they'll just walk immediately because they can tell that you're not grounded in reality. You know that stat that I've mentioned before that 70% of businesses that actually list never sell? A huge chunk of these businesses, they never sell because they're overpriced to begin with. They're missing their buyer pool right from the beginning. And that damage, it compounds. You waste 6 to 12 months on the market with no offers. Your best employees, they usually can sense something's going on. And when you finally drop the price, buyers assume that the business is broken or something's wrong. The real comp for your business is in the business industry itself. In your revenue range, with similar size, similar margins, and businesses that have actually sold in your space. Not tech unicorns, not companies raising venture rounds. If you're a $5 million service business, you're looking at 3 to 5 times EBITDA, depending on your risk and your growth. That's the range. Those media valuations, they're literally all theater. They have nothing to do with what you'll actually get. That kills the comparison myth, but it leaves the door open for the most expensive trap that I see sellers walk into. Once you accept that your business is not worth $1 billion, the next step is to argue that the business is worth more than it is right now based on where it's headed. That move, it costs sellers real money. And almost every owner makes this mistake. All right, point number 2, potential and upside, they don't factor into the valuation. Sellers love to build their asking price based on the future potential of a business and what it can do in the future, if that buyer can execute the growth plan. See, a buyer, they're gonna discount that immediately to zero, and they're never even gonna run those numbers, and sellers can't figure out why. This is always a hard conversation to have with sellers because they want to build the future potential into the price and drive up that price to sell for it. But see, buyers aren't dumb. They're only going to pay you off of actual revenue, actual history, actual profit, and the things that have actually happened. Here's exactly what happens during due diligence. The buyer, he sees a slide that says, if we expand into these 3 markets, we will double our revenue in 18 months. And their first impression is always, well, why haven't you already done this? And the seller's answers, they're not always the same. Sometimes they say, well, I just didn't have time. I didn't have the capital. I didn't have the right team. What the buyer hears is, this isn't as easy as it sounds, and I'm being asked to pay a premium for something that the current owner is not able to do themselves. Look, buyers are equipped to grab data. They've got AI, they've got the internet, they can pull comps and data and industry benchmarks in 10 minutes. They know the difference between a pitch and track record. When you anchor your price and projections, you're asking the buyer to pay today for something that potentially could happen in the future. It's not how valuation works. You get paid for what you built now, not for what the new owner could potentially build. Now look, there's one exception. If you've already started executing a growth plan and you have 6 to 12 months of proof to show that it's working, buyers will pay a premium for momentum. But that's not a projection anymore. That's a track record. And here's the trap that most sellers, they don't see coming. If you lead with projections in those early conversations, sophisticated buyers, they're gonna tag you as unrealistic, unprepared, and not a serious seller. You don't get a second chance to set realistic expectations once you've anchored in high fantasy numbers that are really projections. Talking point number 3, the buyer is paying for proven cash flow, not your vision. Sellers think that buyers are going to be investing in the future of this business. Buyers are actually paying for cash flow producing businesses and nothing more. That's where this one misunderstanding can create a $500,000 gap right from the gate. Look, you got to picture exactly how a buyer views this deal. They will take your trailing 12 months EBITDA, apply a multiple based on risk factors, and figure out how long it takes for them to get their money back. So if your EBITDA is $800,000 and they pay 3 times earnings, let's say 2.4 million for that business, they're looking at a 3-year fully paid back model. And that's if nothing changes. Now, add in your projections and you tell them, if we expand in these 3 markets, EBITDA can be 1.5 million next year. Their model's not gonna change, it's not gonna move. They still paid 2.4 million based on $800,000 in cash flow. If your projections come true, that's upside for them, but they're not gonna pay you for it. The reason is simple. The buyer, he's absorbing all that risk. If the expansion flops into the new market, let's say it doesn't convert, if the growth plan takes longer or it costs more than expected, that's on the buyer. You still get your money. You'll play 0 risk in that expansion. They're not gonna pay today for the potential future earnings of that business. You have to leave some upside for a buyer to be enthusiastic about the deal. The businesses that sell at a premium are where the cash flow cycles are very predictable and stable. They have systems that'll run without the owner, and the risk of decline is very low. Buyers pay more when they're confident that the asset and the cash flow will continue to maintain going forward and has an opportunity to grow in the future. So look, when you are positioning to sell, lead with what already is working. Consistent cash flow, predictable margins, and systems that run without you. That's what buyers want to see, and that's what buyers will pay for. The upside story, it comes later. After you've earned the credibility of the actual real numbers, at that point, the buyer might pay a slight premium for some momentum or offer you some upside on an earnout, but the base valuation will always live in the actuals, not the possibilities. Now, if buyers only pay for what's proven, you think the value that you've built over, say, 20 years would count for something. The catch is, the most valuable things inside of your business usually are the ones that never really make it to the P&L. And that's exactly where sellers get blindsided. Talking point number 4, buyers, they're gonna discount everything that's not on the P&L. You've run this business for 20 years. You know every relationship, every shortcut, every way to squeeze margin. Buyers, they don't have any of that. They assume that the job is harder than it looks, and they price in the risk, which means the value in your head is worth almost nothing until you can prove that it actually transfers. I've had sellers tell me this exact phrase: "We've got a great relationship with this big customer. They're not going anywhere." That's worth something, right? Then in due diligence, the buyer asks a very pointed question. Is there a contract? What's the retention rate? What happens if that relationship is personal and it doesn't actually transfer? If the answer is a handshake deal, I've known the guy for 15 years, the buyer will not price that relationship at all. They'll assume that that relationship could likely leave when you walk out the door. Same thing goes for operational knowledge. I know how to keep costs down because I've been doing this for 20 plus years. That's not transferable unless it's documented in SOPs, training systems, or a management team that will stay on and continue when the deal is closed. Buyers are always going to be conservative in nature. They assume that everything depends on you. The relationships, the knowledge, the systems, that doesn't transfer. If you can prove it transfers, you'll get paid for it. If you can't, you won't. This is where the gap where sellers believe what their business is worth and what buyers will actually pay for your business, this is where it gets kind of ugly. You've been living in this business for decades. You know it intimately. The buyer is standing on an outside model trying to model the risk. The businesses that sell at the top range are the ones where the value is systematized. Contracts, not handshakes, documented processes, not tribal knowledge, a management team that can continue to run the business post-sale, not an owner who lives in the business where the business is reliant on them. If your business is you, and that business is reliant on you being the rainmaker, the closer, the problem solver, the face of the brand, buyers will heavily discount their offer or their value of your business when you actually are the business. Before you ever go to market, you should ask yourself this hard question: what parts of the business depend on me? Then document, delegate, or contract those parts out so that the buyer can see that they'll actually transfer. Talking point number 5, the due diligence process, it's going to reveal what you've been avoiding. Most sellers, they think, I'll just clean up the messy parts right before I list my business. Then due diligence hits, and the buyer, they're going to uncover every shortcut and everything that you've been meaning to fix for the last 5 to 6 years. That's honestly where the deals begin to fall apart. Here's how it plays out. You go ahead, you list the business, you get an offer, you're excited. Then the buyer's accountant, they're going to request 3 years tax returns, 3 years P&Ls, balance sheets, probably a year's worth of bank statements, customer contracts, employee files, payroll reports, vendor agreements, and a detailed P&L that's going to show line item by line item to reveal customer concentration. Suddenly you realize that your QuickBooks files, they're kind of a mess. You've got personal expenses mixed in with business expenses. You've got revenue reported in one way to the IRS and another way on your P&L and tax return. You get key employees classified as 1099 contractors instead of W-2 employees. The buyers, they don't walk away because they find one issue. They walk away because the issues reveal a pattern. This business, it's really been run very informally. And that means that there are other problems that they haven't discovered yet. I've honestly watched deals fall apart just over $30,000 worth of back taxes that are owed. Misclassifying employees over a customer concentration risk. Once trust breaks mid-transaction, it's almost impossible to get that back or rebuild. If you're even thinking about selling in the next 2 to 3 years, hire a CPA to do a pre-sale audit. Have them review your financials, your contracts, your compliance exactly like a buyer would be looking at your business. Ask them what you should fix before you go to the market. The cost of cleaning this up beforehand is a fraction of the cost of what a buyer is going to discount that offer during due diligence when they discover these issues. So a clean business, that's going to hold up during due diligence. But even with clean books, 2 owners in the same industry doing the same revenue can sell for completely different prices. And the reason has nothing to do with how big either one is. Talking point number 6, the multiple you get depends on risk, not revenue. Sellers often hear that their business sells in their industry for say 3 to 5 times EBITDA, and they assume that they'll land on 5 because their business is actually growing. But you see, buyers, they don't price this business off top line. They're gonna price your business and their offer based on how risky that cash flow is. That's the number that most sellers, they never take into account. Here's exactly how buyers build a multiple. They start with the industry baseline, say 3 to 4 times EBITDA. Then they're going to adjust up or down based on risk. Take customer concentration. If half your revenue comes from one customer, the buyer assumes that that customer could walk away and they could lose half of that revenue. That's high risk. The multiple drops to 2. Take owner dependency. If you're the rainmaker, the closer, the deal maker, the operations guy, the face of the brand, if the business can't run without you and the buyer discovers this, they're buying a job, not an asset. The multiple drops to 2 or lower. Look, it keeps going. If the business runs on tribal knowledge and the buyer has to reverse engineer how everything works, that's real risk. And the multiple, it's gonna stay at the bottom. If revenue and EBITDA have been flat or it's slightly declining, the buyer assumes that it's a melting ice cube and the multiple drops. But flip it. If 70% of your revenue is recurring and it has contracts in place, the buyer has predictable cash flow and they've got a lot lower risk. And now the multiple goes up. It's exactly why 2 businesses, similar gross revenues, can sell for completely different prices, because the details inside of that cash flow of how that makeup, that's what matters. It really comes down to how confident the buyer is in the cash flow after they take over. The businesses that get premium prices, they've de-risked everything prior to listing their business and taking it to market. The real valuation, it's gonna come from someone who's actually done the deals, not just Google the formula. You can Google business valuation calculator and get a rough multiple in like 30 seconds. But the gap between that formula and the actual sales price is where business owners, they're probably gonna lose hundreds of thousands of dollars. And the gap, it's really only visible for somebody who's actually closed deals. There is a massive wave in the business broker community. I am seeing so many novices enter this space, and they're coming out of selling cars, selling insurance, selling fitness memberships. These guys are jumping into this space and wanting to handle the most important financial transaction of your life by just putting the title business broker next to their name. That's an incredible amount of risk for a seller who's worked 10, 20, even 30 years to build this company and to plan an exit. Yet, it's happening all over the place, and business sellers, they're getting burned by the advisors that they choose. Look, I took my first company public in 2006, came out of that with a little capital. I then bought and sold 8 different companies myself, and now I've represented over 200 private companies and sold over 400 million in small businesses in the last 16 years. The industry average for brokers, they close 12% of the businesses that they list. I'm selling over 75% of the companies that I represent. The difference isn't effort. Although I'd like to say that I'm a hard worker, it doesn't come down to the effort. It's knowing what actual buyers will pay for, what they're gonna be looking at, and more importantly, where to get the money to close transactions. Here's what happens when you hire a broker who hasn't closed a deal themselves or who has very little experience in this space. They run a cookie cutter valuation, they list your business, the numbers look good, and then it sits on the market for 9 to 12 months with little to no offers. By month 6, your best employee, they're getting nervous. By month 9, buyers assume there's something wrong with this business. If you're thinking about selling in the next 12 to 24 months, start with a real valuation from someone who's actually done these deals. I'm offering anyone who sees this video a free valuation. Normally I charge $3,000 for these business appraisals. I will do it for free to give you a market analysis of what your business is actually worth. No obligation to sell, just a free appraisal so that you understand where you are. We can fill in the gaps of where you want to be, and we can put together a plan, and more importantly, a relationship going forward to help you sell and exit at maximum value, whether it's now or in the future. If you found this video helpful, make sure that you check out the next one on my channel, where I share 16 harsh lessons that I learned from selling 6 of my own personal companies.